live. Welcome, guys, to another live episode. So today's episode is going to be a little interesting. Listen, I'm going to go ahead and go and play some music here, guys. But welcome to another. I don't know. Yeah, it's fine. It's fine. I got to work on my intro music there. But all right, guys, listen. If it's your first time joining me, just do me a favor, hit the like button. Go ahead, hit the subscribe button. It's going to be a fun episode. So while I was doing my research, I was like, all right, what is a good topic to talk about today? Because one of the topics I realized that you guys happen to be interested in is something about finance, business, and almost anything that kind of is like scary. So this topic's going to be pretty interesting. So imagine if you made billions of dollars. Okay, imagine if you made billions of dollars by basically going against the stock market. Imagine if you could make money short in the market. You know how you have everyone who's got bull, bearish, all that stuff. Listen, I'm not a stock market guy. I've learned the stock market. I personally don't see it. It's not something that's for me because obviously it's like, I haven't devoted the time for it. But there are people out there that have devoted their lives to it. And we're going to be studying. So this case is going to be interesting. And if we have the time for it as well, guys, we're going to go and talk about one other person, which is a very interesting person. I'm pretty sure you know this guy's name. But if we don't have the time for it today, since it is a solo episode, we'll go ahead and talk about it on the next episode. But listen, so I don't know if you guys have seen the movie. Have you seen the movie, where the guy was talking about, remember, I mean, if you were alive in 2008, I don't know if you see the memes. So there's a memes that's been going on my Instagram, and I see these memes, and it's like, I got to see if I can find those memes where it's like, when you should be buying a house when you should be buying a house in 2008, but you were too busy in third grade. Have you seen those memes? I don't know if you've seen those memes, or those memes have been going around recently. So what was interesting was, so I was kind of like thinking about it. So I started researching 2008. I'm like, okay, somebody in 2008 made almost $1 billion when the market crashed. Imagine this. There's people out there losing their homes. Like, oh my God, I gotta move. We can't pay rent anymore. We gotta move, right? And then you got people out there like, oh my God, where am I gonna find work? And then you have this one guy that was cashing out 725 billion. All right, I want to go. That's what we're going to be talking about today, guys. We're going to be talking about Michael Burry. So Michael Burry, and he made a prediction, guys. But before we go and talk about that, I want you guys to let's relive. I want to point out to you who he is first. Let's go ahead and point out to you guys who he is first, and then once we do, I'm going to pull this up here on the screen. Once we do, then you guys can pretty much understand what I'm talking about for the most part. But I want to go ahead and pull this up.
We made 725 million, I think, on the funds in 2007, short 8.4 billion of credit default swaps related to mortgages or financial companies. A giant bet, and I was extremely confident in the outcome. I know for sure that some of them thought I lost my money. We made 720.
So think about this. So think about this, guys. He made 725 million in a time in which people thought he was crazy. Because I don't know if you guys were around in 2008. I don't know if most of you were around in 2008, but in 2008 was one of the biggest. 2007, 2008 was one of the biggest crashes, and I wouldn't say it's the biggest, but it played probably an important role, especially in the mortgages, because there was something called the subprime mortgages. So I want to go ahead and I went ahead and found an article, and we're going to go ahead and pretty much kind of like dive into this article, and then based off this article here, that's the expertise. Because honestly, I'm not an expert in 2008 crash, but I want to go ahead and read this. So basically, the reason why the stock market housing market crashed in 2008 was basically due to the growth of subprime mortgages. Okay, so subprime mortgages, you had basically think about it for the census too. People were getting approved for loans for houses that they basically could not afford to pay for, right? So the subprime mortgage crisis, so the banks, which caused a lot of banks to collapse, because I don't know if you guys have paid attention to what I talk about here. So a few of the things I talk about, we talk about basically how the banking system works, right? Which we pretty much talk about, currencies, how we basically talk about the banks. You go into the bank, you're like, hey, I go into my bank. I'm not going to name any banks because, I'm not going to give it smoke today. But you go into a bank and you give them, whatever amount of money you give them. And then they say, hey, okay, good. We'll keep 10% of it. And I think as of now, they're not required to keep 10% of it. And then they go ahead and loan the rest out, 90%. And then they charge somebody else 6-7% interest on it. So basically the money was never printed, they literally created the money from thin air. The money was legitimately just like, poof, poof, here you go. Here's money. Here you go. You get some, right? So they were like, Oprah, you get some money. You get some money. You get some money. You get some money. They were just like going, Oprah. They were like doing that scene from Oprah. I gotta find that scene there. But the Oprah scene, I gotta have all this stuff and sound effect all tuned in, guys. But Literally, they were like, you get some money, right? And that kind of led into what was basically called, the 2008 crisis, where basically subprime loans. So the key takeaways: the stock market and housing market crash of 2008 traced the origins to the unprecedented growth of the subprime mortgage market that began in 1999. So which means this had been going on in the late 90s. So for 9 years, this has been going on. So Fannie Mae and Freddie Mac made home loans accessible to borrowers who had low credits and a high risk of defaulting on loans. The subprime borrowers were allowed to take out adjustable rate mortgages with low starting rates that would increase after a few years. Okay. So financial firms sold their subprime loans to large commercial investors in pools of mortgages known as mortgage-backed securities, right? So basically, by the fall 2008, borrowers were defaulting on subprime mortgages in high numbers. The collapse of financial markets and the global recession ensued. But now, for us to pretty much understand this, right, we got to understand what is subprime loans. So to understand what subprime loans is, we're going to go ahead and watch a video here, guys. We're going to understand what subprime loans are, and then we're going to go ahead and dive into 2008 crash, and then we're going to talk about how Michael Burry basically made his money. So I want to go ahead and pull this up here.
Almost crashed the U.S. economy was precipitated by the bad behavior of some of the biggest Wall Street banks. And it was their creation of the so-called subprime loans that almost brought about the country's ruin. CCTV's Rochelle Akufo takes a closer look at one part of what billionaire entrepreneur Warren Buffett has called financial weapons of mass destruction.
There are several kinds of people who borrow money from banks. For simplicity's sake, we'll use a grade system from A to F. A being the highest mark, with F being a fail. If the borrower has an A grade, banks fully trust the person and expect him or her to pay off the loan in full within a certain period. They're usually borrowers who have high worth assets, a sizable bank account, and a stable or high-paying job. If it's F, there is no way that person can pay back any loan, mostly because they have no income, no assets, or even a steady job. Borrowers in the middle, grades C to D, are basically the ones who apply for subprime loans. They're the borrowers who usually have low-paying jobs and have a hard time making ends meet. It's also highly likely that they didn't go to college and live in low-income neighborhoods. That's why lenders consider these borrowers as a higher risk, and that means their loans have a higher interest rate, at least 2 percentage points higher compared to borrowers who have an A or B grade. So why do banks lend to the subprime borrower, given that they're more likely to default? According to some banks, they loan to these people with expectations that they will eventually get better paying jobs, and that will let them meet the interest payments. Unfortunately, this only works in theory, since most subprime borrowers have fixed incomes. Most of them are retirees or qualify for fixed government assistance.
Okay, so that's basically the subprime loan. Okay, that was very, very, very that was very, very basic there as far as the subprime loans explanation. But think about it from a perspective of you lending to basically, if your credit skill, let's say you went into basically to the bank to borrow, and you had a great credit track history, great payment stuff, and all that stuff, right? The bank's like, hey, okay, listen, hey, you're good, you're not at high risk, so we'll give you the money. Versus I show up and like, oh, hey, you have all this stuff, I'll be considered a subprime kind of example there, right? So basically, think about it as far as they were just giving loans to anybody. It doesn't matter if you could pay it back. It doesn't matter. They were just like, hey, you get the money, right? Oprah on them. So what ended up happening was you basically had the market where people were buying houses. I heard stories of people buying 4 to 5, 6, 7, 8, 9, 10, 11, 12. They're just buying houses that they could not even pay for because they were getting approved for the loans, right? It was just like, but then again, you can't think about what's the incentive for the bank is, because the incentive for the bank is like, hey, you're loaning this out. They get to say, they create mortgages. There's something that I actually am going to dive deeper into to understand the 2008 market crash and how it happened. But one more thing as well, guys, because before I go ahead and talk about what Michael Burry is doing right now, because we're going to dive a little deeper as to what he's doing right now, why people are concerned about it, what he's doing. But for you to do it, I want you guys to understand what happened in 2008, because we have to go back to the origin of where it all started. And, the origin of where it all started was basically going back to 2008. So we're going to go ahead and go into the 2008 market crash explained. It's a 2-3 minute video, guys. So if you're watching this on Spotify, go ahead and like the video. If you're if you're watching this on YouTube, go ahead and do me a favor and also go ahead and share this with someone who you believe this is going to be on value to. And please don't forget to sub as well. Okay, if I didn't say that already. All right, but let's go ahead and give us a listen.
Disposal to control the economy is the interest rate. When the economy is rising too fast, the government intervenes and raises interest rates to stop the flow of capital into the market.
So if you kind of look at it right now, if you look at it right now, if you look at the current interest rates going up, you see people like, oh my God, why is Jerome Powell raising the interest rate? Well, it's raising the interest rate because you understand it's to when you raise the interest rates, what happens is basically there's less borrowing that's going on. So basically there's less spending. So basically there's less inflation going to the economy. So when interest rates go up, inflation goes down, right? Because what is inflation? Inflation is basically a surplus of the US of the currency into the market, supplying way more than the demand, and then you have the devaluation of that currency, right? So think about it as to, whenever imagine if right now you ate your favorite food, right? Whatever your favorite food is. Imagine if you ate your favorite food for, let's say your favorite food was rice and beans, right? Or paella or something like that. You ate your favorite food for every day for the next year or 2 years. Eventually, you're going to be like, okay, this is crazy. This is insane. I need something else, because as human beings, you and I know that we get tired of the same thing over and over again. So that's basically now you start to look at the census to where you're like, you've overinflated, right? So basically it's now not that much valuable. It's like, imagine your favorite song. When you listen to your favorite song, right? You like, like for instance, I go on iTunes and I find a song I like and I'm like, oh my God, this is so good. I'm listening to it. I like the song. I mean, I'm vibing with the song. I keep playing it on repeat every day and day out. And then after maybe 3 weeks, I'm like, oh my God, I can't stand this, right? So that's kind of how you're looking at it from the sense of that's a simple explanation of inflation, right? But there's a little bit more economical kinks that go into it. I'm just kind of trying to give it more of a simple explanation because, I like to keep it simple, right? But let's go ahead and continue back into what this video is basically talking about here so you guys can understand.
Economy doesn't turn into a bubble because high interest rates means borrowing money becomes expensive, which means less people would borrow money, which will result in less spending. And vice versa. That's known as monetary policy. So back in 2000s, when the dot-com bubble burst, the stock market lost almost $5 trillion of market cap. The economy was in a recession, so the Fed lowered interest rates from around 3% to 2.5%, then to 2%, all the way down to as little as over 1% to encourage everyone to borrow money and spend in order to get back the economy on its knees. And it worked. By 2003, the economy began recovering. By 2006, the stock market reached its pre-dot-com crash levels. But low interest rates means low rate of return on government bonds and interest on fixed deposits. It no longer made sense for investors to buy government bonds or keep their pile of cash in the banks, since inflation would slowly eat it away, especially when a few years ago they made unbelievable returns during the dot-com bubble. The S&P 500 rose by over 400% from 1995 to 2000s. So investors were looking for a new opportunity, a safe and rising investment to throw their money at, and real estate seemed like a great idea. But investors don't have the time to deal with individual buyers, so financial institutions came up with a brilliant idea. Since interest rates were so low, everyone was buying a house. So financial institutions would take these mortgages, bundle them together, and sell them to investors in forms of shares. These investments proved to be really great. But banks ran out of financially responsible people to loan mortgages. But investors still wanted to buy these investments. So banks started giving subprime mortgages, or mortgages to people with really low credit scores. People didn't necessarily have enough income to keep making the mortgage payments. Why? Because they would take these mortgages, bundle them together, and sell them to investors. Low interest rates and rising home prices kept attracting more and more investors. The reason why these investments appeared so seductive is because the investors argued that even if they would default on their loan, it's not a big deal. The bank can take back the house and sell it, and since home prices were rising, they would still make a profit. It seemed like the perfect investment. So the banks gave mortgages to everyone. That inflated home prices to unbelievable heights. But at some point, one of the borrowers defaulted. So his home was put on sale, then the second one, then the third. Soon, there were so many homes on sale, but not enough buyers, and home prices began to fall. When people saw that their $500,000 mortgage house is suddenly worth only $250,000, it stopped making sense for them to keep making mortgage payments, so they walked away from them. Now, there were even more houses on sale, driving home prices even lower. So the banks were left with a lot of worthless mortgages that no one wanted to buy, so they went bankrupt one after another.
So that's interesting, though. That's interesting to think and look at from a basically from a standpoint as to, I don't know if you guys are pretty much understanding the most part. Honestly, I personally didn't even know that, if I'm being honest with you, as far as the investor part of things. But I see it in the sense as to, because you guys know, if you invest in treasury bonds, you invest in, any people say certificate deposit, but if you get in treasury bonds, even CDs, I believe, give you a better return than actually doing a traditional savings account. So it actually makes more sense, much more sense for investors to invest in something where, because if you have inflation, standard inflation of about 2%, 2.5% to 3%, and you have something yielding you 4.5%, maybe even 5%, and you're beating inflation by 2.5 basis point. What does that mean? Let's give an example, because most people don't understand how inflation works. I don't want to kind of get too much into the nitty gritty, because we haven't delved deeper into what Michael Burry basically, what he's doing right now, and what has a lot of people concerned. But let's go ahead and kind of dive into a little bit. I want to go ahead and show you guys something here. So let's go ahead and dive into the board. Let's dive into the board, because you know that I like to do a little bit of what you call it, a little bit of training here in this. So it's kind of like a podcast / tutorial kind of stuff. But let's do a little bit of inflation. So what is inflation? What is basically inflation? Well, how does that? So let's look at it from perspective. Let's say you got $100 in your savings account, right? And inflation is 2%, right? So that means 2% of $100 is $2. So which means, what does that mean? Is if inflation is annually about 2%, for every year that you keep your $100 in your savings account, you're losing $2. So which means if you put it now in 2023, right, it'd be negative $2. So you'll be at 98. If you leave it in 2024, you don't compound anything, you'll be at 96, and then 94, and then it just keeps going down and going down and going down. So eventually the money pretty much goes to zero. But you're like, Emmanuel, what do you mean my money's going down? My money's not going down because it still shows me $100 there. Well, here's how you got to look at it. If you were born in 1908, let's say you were born in 1895 or 1878, the average wage, the average earner made about $2 per day, right? So that's the average wage, was $2 per day. Now you cannot even buy a bottle of water for $2. Okay, so I want you guys to think of this perspective. So the average wage was $2 per day. Now you can't even buy a bottle of water for $2. Now you're looking at the buying power of $2. So if back in the day you could pay your mortgage for $20, if you could pay a mortgage for $20 in a month, now the buying power of $20 has been reduced to the point in which you can maybe buy a large pizza at that, if you're going to go pick it up for, carry out instead of a delivery. So you got to think about it. $20 in 100 years ago, you were able to use $20 to be able to basically pay off the house you're living in, your rent right now. Now $20 won't cover anything. 50 years ago, you could use $250, $300 to basically pay your mortgage, right? Now that $300 will not even cover your light bill or even your car payment, right? So you're looking at inflation. So what does inflation? What does that do to currency? Basically reduces the buying power of it. So what you're able to acquire, it's not worth the same. So what does that mean? That means is if inflation rises, your $100 right now will be worth 98 in a year, and then in another 10 years, that $100 will maybe be worth $40, right? So basically, whatever you can buy for $40 right now is what you'll be spending $100 to buy for $40. So let's think about it. If $40 bought you, if $100 bought you 5 boxes of pizza, okay, in 10 years, that $100 would only buy you maybe 1 or 2 boxes of pizza. Okay, now that's basically, that's obviously it's kind of a little over exaggerated. Maybe in 15 years, buy 2 boxes of pizza. But that's what inflation is. Inflation basically means that the currency is basically losing its value, right? So that's basically, think about it. So it makes more sense. That's why I don't I never advise anyone to go into savings. Don't save your money, because I don't think saving. I think invest it, right? Yeah, you should have your savings for emergency in case something happens. But I recommend you invest, because your investments actually to beat inflation. Okay, that's actually what's protecting your money. Investments, if you look at it, anything that gives you more than 2 or 3% is actually protects your money. Now the inflation rate is so insane that, you know, unless you invest in something that's giving you a 20x return, I mean, I don't think anybody's money is really safe, if you ask me. But then again, this is not professional advice, so I can't really comment on that, right? But basically, now you have an understanding of what happened in 2008. Now you understanding of the subprime loans, and you have to understand. Now you understand how basically the market got into a point where pretty much everyone was like, yeah, there's now, you know, Houston, we have a problem. And obviously, you know, the government basically came in with more incentives, and, you know, and hence you had the 2008 crash, right? But now we covered in the beginning, Michael Burry made $725 million from what was going on. Okay, yeah, the big short in the mortgage, because no one believed them, because everybody was like, hey, this is not gonna fall, nothing's gonna happen. But he's like, somebody's gonna default, and he just used common human psychology. It's like, hey, if somebody defaults on the loan, right, and a lot of people default, home prices drop, and home prices drop. What happens is the banks aren't going to be able to, this bonds and stuff that they're issuing for the mortgages is not going to be worth anything in the future, which means everyone's gonna default. And we know that the banks don't keep your money, right? The only way the banks survive is the banks survive as long as new money's coming in and nobody's taking their money out, right? That's how the banks survive. And then basically he's just like, did the math. He's like, hey, they're not going to really have any money to back this, because they're just making and printing money out of thin air. And then boom, he was right. And then boom, next thing you know, you have the market crash, right? You had pretty much what happened. But now, he has something said, and we're going to actually, this is a little bit of a longer video, guys. So thanks again for everybody staying on here. Now, this is a little bit of a longer video, and I want you to go ahead and take a listen to what he's saying might happen in the next, you know, there's no timeline for this, but people are pretty much thinking about it, and everyone.
Michael Burry, the investor who became famous for predicting the massive 2008 housing market collapse in the US, appears.
Let's go ahead and get this started.
To have recently placed a big bet against the US stock market. Now, he was featured in Michael Lewis's book, The Big Short, which was made into a movie.
The whole housing market is propped up on these bad loans. They will fail.
The housing market is rock solid.
It's a time bomb.
So Mike Burry, who gets his hair cut at Supercuts and doesn't wear shoes, knows more than Alan Greenspan.
Dr. Mike Burry, yes, he does.
Well, this time around, Burry has bought $1.6 billion worth of financial instruments.
Think about this, $1.6 billion. He's bet a $1.6 billion on basically the stock market crash. Okay, $1.6 billion.
Options that would allow him to profit from a stock market fall, according to a filing made with US regulators. Let's bring in Julia Chatterley in New York. He reckoned that he understood more than.
Now, they're just going to go ahead and talk into a few things. We're not going to go ahead and dive into that, but I actually am going to go ahead and dive into an article here. And I don't want to listen to, you know, there's going to be a debate and stuff. We'll talk about that and all that stuff, but you can go ahead and watch it yourself. It's on YouTube. So basically, this is Michael Burry's basically big bet of $1.6 billion on the market crash, right? So there was a point in which he released a tweet. Because all right, so a few things we're going to cover. We're going to cover this article, and then we're also going to go on Twitter, because on Twitter is where it gets a little bit interesting. So Michael Burry, the big short investor who became famous for correctly predicting the epic collapse of the housing market in 2008, has bet more than $1.6 billion in a Wall Street crash. Burry's making his bearish bets against the S&P 500 and the NASDAQ 100, according to, you know, his filing with the SEC. And this was done in August on Monday. Basically, so he uses he uses Scion Asset Management, okay, which bought basically put options, options to sell, 866 million in put options. That's the right to sell an asset at a particular price, right? Against a fund that tracks S&P 500 and $739 in put options against a fund that tracks the NASDAQ 100, right? But he's using more than 90% of his portfolio to bet on a market downturn. Think about it, guys. If you are not sure about something, I want you to think about it. Imagine if someone tells you, hey, Emmanuel, hey, John, hey, Timmy, how sure are you? If you're so sure about this, put your money in. Put your money there. And this guy is so sure about the market crashing that he's putting 90% of his market portfolio. 90%. That's not a small amount of money, guys. It's not a small amount of money. 90%, 1.6 billion. It's not a joke. I don't know if you guys understand what 1.6 billion is. So let's look at this. Let's understand this. What's the GDP? So let's look at this. What's the GDP of most countries? All right. All right. Let's look at this. I gotta spell countries right. Jeez. All right. What's the GDP of most countries in the world? So I want to see if I can find it. If we can find a comparison here. So if we have the GDP of most countries, so that's a 1.6 billion dollar bet. So let's go ahead and see. Let me see if I can find something covering the GDP of most countries. Let me see. Not gonna find one, but the GDP. I'm gonna see this. I think that's there's a country of. There you go. That's it. I have a very slow internet. So GDP by country. So we're going to look at this. We're going to look at a GDP by country. Okay. And we're going to see what country has a GDP of 1.6 billion. Okay. We're going to go ahead and see what a GDP is. And for those of you who are like, Emmanuel, what do you mean? What do you mean, GDP? What is GDP? So GDP is basically gross domestic product, right? So think about it as far as the best way to put it in simple terms would be, how would I put this in a very simpler way that no one's. So it's basically, let me read this off of Google. So GDP measures the monetary value of final goods and services, that is those that are bought by the final user producing a country in a given period of time. So think about it, basically what the currency, the gross domestic product value that's coming out of a country, right? So now let's go ahead and look at this. So let's look at the GDP, right? Let's look at the GDP. You can determine by, hey, this country is a pretty rich country because you have a gross domestic product value of so and so, right? So let's look at the GDP. So let's look at the GDP of countries. So obviously you have the US. You have the US pretty much with the GDP there of 25 trillion. I believe that is trillion, and 17 trillion. China, Japan is 4 trillion. Germany is 4 trillion. All right, and we're gonna go back. We're gonna go down to the GDP here. So you had Uzbekistan 80 that's 80 billion. And let's navigate way down. Let's look at the GDP. I want to look at the GDP of countries. So you have basically St. Lucia, 2 billion. So he's basically making the bet of Guinea-Bissau. Okay, now we're looking. So his bet is more than the Guinea-Bissau, Solomon Islands, Grenada, Samoa, Dominica, and you basically, he's betting the GDP that is more than at least 10, 15 countries. Okay, that's what he's betting on, the fact saying that, you know what, this is how much the market is going to, this is my bet saying that the market is going to crash. Okay, but it gets a little bit more sinister, guys. It gets sinister here. Okay, I want to use the word sinister because it actually does get sinister when you start to look at it. Because like I said, guys, we're going to actually talk a little bit about what his Twitter looks like, okay? Because that's the thing I want you guys to look at. There's something he does on Twitter, and we're going to look at it, okay? He has a very repeated pattern what he does. So Burry's making his bearish bets against that, and obviously you look at the 60 million. But Burry appears to have been wavering between bullish and bearish on the stock market and blah, blah, blah. But in January, he tweeted a cryptic message, okay? He tweeted a cryptic message to his 1.4 million followers on Twitter saying, sell. He said sell, he wrote. But by the end of March, he backtracked. I was wrong to say sell, he wrote. And everyone is saying, you know what, man, this guy's, what's up with him? Because the S&P, is up 16%, and you got the NASDAQ up 38%. So what is this guy talking about, right? But in the mid-2000s, Burry was famous for placing a wager against, obviously, the 2008 crash. And everybody was like, oh, who are you? Blah, 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 to make this bet. Blah, 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 blah. But if you notice what ends up happening, the market ended up crashing. And obviously, if you look at it, he's also, I think people are reading too wrong into what's going on, because the guy is staking 90% of his bet. Okay, he's putting 90% of his money, which is 1.6 billion, into saying that the market would crash. But everyone's like, well, but he's also a little bit bullish, and also, what bullish means is also like basically making positive investments. If you look at it, Burry has also purchased 4.7 million in shares worth of the CNN parent company by Warren Burroughs, and 3.3 million in an online retailer, and then also MGMs, also. So this is just safe bets. And I personally think he's making this bet to distract people from like saying, hey, everyone is talking about him like, hey, you're a very influential person and you betting 1.6 billion. Are you trying to control the market? He's like, no. So to prove he's not controlling the market, he's putting in $10 million, or basically, think about it, bet 4.7 and 3.3 million. So he's putting 8 million to say, yeah, it's fine. Hey guys, we're not doing anything. I think that's just basically a distraction, because he knows what's going to happen. Is he knows that the market probably is going to basically go ahead and face a crash. But now let's go ahead and do this. Let's go ahead and go to his Twitter, right? Because let's go to his Twitter, because when we go on Twitter is where you kind of go ahead and start to see, okay, hey, there might be something here. What's going on here? All right. So let's go to his Twitter. So in his Twitter, his tweets are very, very, very interesting. Okay. His tweets are very, 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 very interesting. So this is his Twitter here, and this is his tweet. All right. So Cassandra BC. So his tweets, you're like, okay, all right. Here's the most interesting thing about that. All right. 1.4 million followers in post. How many posts does he have? 0. He doesn't have any posts. Right. You're like, okay, man, what do you mean his tweets are interesting? He is trying to not get canceled. Okay, because he knows something, that he cannot tell people the truth, because the thing is, everybody always says, hey, I want the truth. He can't tell people, because if he says sell and people go sell, they say, hey, you did that to influence the market, he gets a fine and boom from the SEC, right? So you can't do that. You got to be very, especially when you're in the financial industry, in the financial market, you cannot say sell, you cannot say buy, you cannot say anything that influences people's decision, because if you're doing that to the masses and people are doing it, you're some way trying to influence the market, boom, you can get hit with some decent SEC fines. And you guys gotta be very, 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 that's why he's got to be careful. But the thing is, he has 0 tweets, 0 posts, 0, because he's like, I'm not gonna play the social media game. I'm not gonna play all these games and all that stuff. I'm just here to make money for my investors. And he's like, based off of the way the spending is going, he's like, you know what? I personally think this overinflated. The market's going to take a big, it's going to need a big correction, because everyone's like, oh, it's bullish. But, that's kind of what he's thinking. I'm very curious what you guys think about it. So definitely go ahead and leave the comment below. And then next episode, guys, this is a little short, but next episode, we're going to be talking about, the growth of a very interesting company. This company is very, very interesting. When I mean they're interesting, this company basically they have a very, very great leader that pioneered. He had a vision and he took over the market. But now, guess what? His position in the market is very, very threatened. I know you guys know who this guy is, and we're going to be talking about him in the next episode. So definitely go ahead and stay tuned, guys. And that's pretty much what I have for everyone who is joining me here. And please, if you find this video helpful, share the video. And also, if you're on Spotify, do not forget to hit the follow